Today is all about annual allowances and how you can use your annual allowances in building wealth for the future. My name's Neil Jacobs. I'm Head of Fusion Financial.
I'm Joshua Shepherd. I work alongside Neil within the Fusion Financial team.
And Fusion Financial team is part of the larger group of Fusion, which entails Fusion Tax, Fusion Accounting. We also have Fusion Law, Fusion Recruitment, and Fusion CFO as a Service. The huge benefit of having all of these departments under one group is when we work with a number of clients, it's very easy to communicate with our counterparts in other departments to make sure that our clients get the best results. So this webinar is actually part of a wider series. We have a couple more coming up later in the month. They are on...
So we've got one with Fusion Tax team, and then a joint effort from Fusion Accountancy and the CFO as a Service team, which will be interesting to those of you with small or medium-sized companies.
Today, obviously, we've got the introduction as the first part of this presentation. And then we're going to start looking a bit deeper into your annual allowances. And then coming to the end, we'll look at a Q&A. Some important housekeeping. On the right-hand side of your screen, you see the three dots. If, like me, it all looks a bit too small, click the three dots. You can expand it. On top of that, you can also use this area for the Q&A and ask us some questions on the way. We'll probably answer them at the end, but if it's pertinent to what Josh or myself are discussing, we may feed it in at that point. So, maximizing your tax efficiency is really important each year. For many allowances, if you don't use it within the year, you could lose it. So it's really important to understand what allowances you have and not have any tax liabilities that you are missing out on. Areas that are going to be a key focus really for today are going to be some of the obvious ones that I should think quite a lot of you already have heard of. ISAs, cash ISAs, investment ISAs, pensions. Then some areas that maybe are less well known, such as venture capital trusts or enterprise investment schemes. Sorts of allowances that may come into play here are your capital gains allowance. And today's goal is really to help you make a more informed decision. Obviously, we're getting really close to April now, end of the tax year. So some of these allowances may be still available. So by using this presentation today, it may make you think, oh, is this something I should be doing? And make you actually think a bit deeper into how you can really maximize those allowances in building that wealth for your future.
Thanks, Neil. So, as Neil said, there are ISA allowances and pension allowances, which every individual in the UK has access to. Now, the question that you may be asking is which one of these should be utilised first, which one is more important, and which one is going to suit you best in terms of your individual needs. And the answer to that is very much personal to your circumstances. But I think in order to get to an understanding of the answer of that question, you really need to understand what each of the ISA or the pensions, it represents in terms of the allowance, the growth within, and what that means and when you can access it. So ISAs here in the UK, there's a lot of confusion about ISAs, and I always question why that is. And I think it's because there's so many different types of ISA that are packaged up across the board. So you will see things like cash ISA, you'll see things like stocks and shares ISA, you'll see things like investment ISA. And what an ISA is in its most basic fashion is a wrapper to hold your money and allow it to grow in a tax-free way. So an ISA as a wrapper in its most simplest form allows for investment in either cash or investments. Now, depending on what your retirement goals are, what your time horizons are, and what your risk level is, that will determine whether a cash ISA, an investment ISA, or some kind of hybrid version is most suitable to you. But what isn't different for each person is the £20,000 allowance that you get every year, which resets on the 6th of April at the end of every tax year. So each tax year, you can put in £20,000 into your ISA. Now, within that ISA, that £20,000 is now protected from any interest tax, from any capital gains tax, or from any dividend tax, meaning that the value of that ISA is the value that you could take out and spend the very next day without any tax implications at all. So that's great. Whether you should be using the full allowance or part of the allowance will all depend on what your surplus income is and whether there are other products or investment types that you should be utilising first. But everybody has access to that £20,000 allowance. Now, junior ISAs are something which under 18s have access to but can't touch. So that means that, if you were to set up a junior ISA for your children, it works in very much the same way as the ISA, other than the fact that it is locked away until your child turns 18 and they can then access it. So the allowance for the junior ISA is £9,000 per year. And it is always recommended that, you only go into the junior ISA once you've maximized the allowance for the standard ISA because of the way that it's locked up until it's 18, right? So that's okay. Now, with regards to pensions, everybody who's working will be invited to join a pension scheme through the auto-enrollment rules. And in order to fund that pension, you may either pay through your work salary, coming out at the end of the month on your payslip. You may make direct contributions if you're a director of a small or medium-sized company, or you may make personal contributions into the pension on top of any contributions you've already made. Now, what are the limits for pension contributions? Well, it's either up to £60,000 per year or the maximum of what your earnings were in the year that we're in right now. Now, the one difference between pensions and ISAs in terms of the allowance is that at the end of the tax year, your allowance isn't just gone and evaporated. You can actually go back 3 years previous to utilize any unused allowance that you haven't yet utilized. So that's a very key difference and allows for, in those good years where either you've received a bonus or your company is doing very well, you can make additional contributions into your pension to maximize the potential of it as time goes on. Okay. Now, with regards to the carry forward allowance, that goes back 3 years in total. And again, the clock for that is the 5th of April every year to make those contributions.
So this year, would that be 21, 22 would be the year that drops off?
Exactly. So if you haven't used the full allowance of the tax year 21, 22, then at the 5th of April, at the end of the 5th of April, you will no longer be able to go back and use the unused allowance.
Thank you.
Now, ISAs and pensions are, things that, you probably have all heard of and have all, one way or another contributed to whether that's one or both types of investment. Now, outside of that, and, at the point where you've maximized all of the allowances that you've got with ISAs and with pensions, what can you do? Well, a lot of people think that, you're left to just hold your money in savings or hold it in cash or make an investment through a general investment account for which it will be subject to capital gains tax. Now, that can work and it is a good strategy depending on your circumstances. But what people don't always know is that there are other tax advantaged investments here in the UK which can either benefit from tax relief on the way in, inheritance tax relief if you hold it for a certain period of time, or tax-free growth and dividends within that type of investment. So I'm just going to break that down in a very simple way, and anybody who kind of wants to hear more information on these types of investments can get in touch for a further discussion on it later. But venture capital trusts is essentially a portfolio of companies that are here in the UK that are on that scale up journey. So, they're not the smallest companies that are just starting out. with no kind of performance history or return on investment. They are companies that are looking to continue growing from where they are now to a place where they can maybe go listed on a stock market or remain private. Now, the benefit of investing in those companies is that for every £1 that you invest into a venture capital trust, you will get 30p of tax relief back. Now, how does that work? Well, it's based on the income tax that you pay in the tax year. So if your income tax bill was £10,000 in this tax year, then in order to get the tax relief on that, you could make an investment of about £30,000 into a venture capital trust, and on your tax return, you'd fill out the box that says venture capital trust investment, and you'd receive a £10,000 tax refund from HMRC. Now, enterprise investment schemes work in a similar way. The only difference there is that rather than being invested in a portfolio of companies with a live sale price, we're investing in direct companies. We have a direct holding in each of the companies within the portfolio, and because of that, they're a slightly higher risk investment, which means that not only do you benefit from the 30% income tax relief, but you also, after 2 years of holding the shares in that company, you benefit from that investment being outside of your estate for inheritance tax purposes. So it's another key benefit of these tax advantaged investments. Okay, so many of you may be in this position where you're higher earners, and now what that means is that you're earning over the £100,000 bracket, and you may think that because you're earning over £100,000, because you're earning over £50,000, you pay 40% tax on those earnings. But there's a slight discrepancy in that, in so much that when you reach £100,000 and beyond, between 100,000 and 125,000, you end up losing your personal allowance at a rate of every £1 for every £2 that you earn. So that means that when you get to £125,000, you've effectively paid a 60% tax rate on the difference between 100,000 and 125,000. So therefore, it's a very tax inefficient place to be. And it means that there may be a better way of either saving your funds that are coming in through your salary or investing through your pension in order to get some of that tax back and put yourself back in the 40% bracket that you thought you were in the first place. So there's a number of ways to mitigate that. The most common and the most obvious is to make an additional pension contribution. And if you do that, that pension contribution is obviously a net pension contribution. So if you earned £110,000 in the year and you made a £10,000 contribution, the effective cost of that contribution would only be £4,000, meaning that you've had 150% return on your investment from day one, just through the tax relief. Does that make sense?
Brilliant. So let's have a look at the final tax year end checklist. Maximise your ISA allowance. I think the important thing here is, for some people, it may be hard to achieve 20k, and for some, it feels like a small number. For the ones where it feels like it's a small number, over time, building up that 20k year after year, it can become quite a sizable event when you suddenly have, six figures, hundreds of thousands built up a wrapper where the money's tax-free. And on the other side of the spectrum, whatever you can afford, really, it's still going to make a difference. And as you progress through your career, you've built up something on the side where there's no tax to pay. Pension contributions, utilise as much as you feel you can afford within that 60,000 allowance, bearing in mind this money is tied up until you retire. So it's getting that balance right. But like Josh said before, for many people, it's more of a means to an end. Not only are you building up and investing for your retirement, but also maybe to regain some or all of your personal allowance. You need to really assess the viability of VCTs and EIS investments to ensure they are a good fit for you and you're comfortable with that risk that's got to be taken. Make sure you're using your capital gains allowance, which we know has just dropped and dropped and dropped and now sits at £3,000, but it's still something worth using. Like we said, and I said just a moment ago, if you can try and get your income under 100,000, it is going to make the tax you pay a lot less. And obviously, in terms of inheritance tax, which is these days getting harder and harder to mitigate, we do have a 3,000 allowance each year, which again, for some people, if they can do that year in, year out, it can build up over time. So all of these things are what we need to consider year on year. But for this year, coming up to the 5th of April, if you do want to discuss any of these areas, please get in contact with myself or Josh at Fusion Financial. We can have a meeting, no expense, and really get a bit deeper into what solutions best fit you as an individual and your family. So now we're getting to the question and answers. So if it's all right with you, Josh, I'm going to get, probably you guys watching, I'm going to get a bit closer, just read a few out and take it from there. So we've got a question here. Is ISAs available in the UK residents living overseas? Well, if you are a non-resident of the UK and living abroad, you won't be able to utilise your ISA allowance. If you're a resident in the UK living here, that's really where the ISA kicks in. If you have ISAs in the UK and move abroad, you can still keep them here, but you can't make any further contributions. Anything you'd like to add to that?
No, just on that, it's all going to depend on your individual circumstances. You know, how many days of the year do you spend here in the UK? How many days of the year do you live abroad? And is there a way to contribute in the time when you are here because you are still a UK resident? And that's something that we can assess on a case-to-case basis and decide whether an ISA is still the right type of investment for you or if there's something else which is more suitable.
So we've got another question here. If you're not working and only reliant on investment income, can you still contribute to a pension scheme?
So yes, in that case, Colin, you can still contribute if you're only reliant on investment income. The amount you can contribute will be up to £3,600, depending on your earnings. Now, if your earnings are obviously zero, then that's the maximum that you can contribute to. And that contribution, do you want to touch on the age of contribution now?
Well, if you can actually have a pension for underage, there is restrictions on how much can be paid on that. But in terms of once you start working, under auto enrollment rules, it's 21, but you still, let's say you skip college, go into employment, although you won't get automatically enrolled, you can choose to go in a bit earlier and obviously start building up your pension pot at that stage. So it's one of those things for me, being a bit lazy, I'd sooner walk up a hill than a mountain. I have a lot of clients that have children and a part of my job is also educating them. So if you have any children that are going into employment, the earlier they start, not only does it improve their behaviours, even if the contributions aren't significant, it really impacts the way they think about money and will allow them to start building up a pension pot and using that behaviour in other aspects of their life as well.
And what about if you get older and you're approaching 75? Is there limits on what you can pay in at that point?
So if you want to take your tax-free cash before the age of 75 and start taking income from your pension pot, that may impact things, but obviously you can still contribute into your pension if you haven't taken any additional income from your pension.
Yeah, I think another key point is, the minute that you take income from your pension, that triggers what's called the money purchase annual allowance, and that reduces the £60,000 allowance that you would have down to a maximum of £10,000 per year. So it's another thing to be cautious of in terms of when is the right time to take the funds from the pension, because you may cause yourself an inability to contribute back in once you've started drawing down.
Another thing we should probably highlight on pensions that's come through the budget. Previously, in a lot of situations, Josh and me would advise not every client, but some, that at retirement, actually, this pension pot they built up may not be the first place they go to for income, especially if they've got other income sources. The reason why is, and it's still the case today, that your pension can effectively stay out of your estate. However, due to the budget in 2027, that's all going to change. It's not great. Obviously, it was a really useful tool in many ways, but it does make a pension, I guess, a bit more pure again. A pension is really there for your retirement. So now Josh and me have pivoted a lot more in our advice. Enjoy it. Turn on that tap and enjoy the income it's producing, because anything left in that pot upon the time when you are no longer here, you will effectively be paying inheritance tax on. So, things are always changing. It may change again.
Thanks for the question, Greg. And you said kind of if you want to utilise previous year's allowance and the carry forward, do you need a pension already in place? Yes, you do. So if you had never had a pension and you set one up and you said, look, I want to make more than the £60,000 contribution allowance, you wouldn't be able to, because this is your first pension that you've had. But if you had one previous, even if you weren't contributing to it, that is enough of a base to continue making the contributions using the carry forward allowance.
Okay. Is there any other questions there, Josh? So
is there any form of company ISA or only personal ISAs? So do you want to take that on now?
Yeah, no, it's very much a personal allowance. A pension is a personal allowance that a company can contribute to. An ISA is very much an allowance where the benefit is received within the wrapper. Whereas with a pension, you get the benefit going in and when it's in. And obviously, we all have it where our companies are paying into it, our employer, the firm we own. So, no, they're quite separate. They can work really well in tandem. But like I said, the ISA is very much personal. You've already paid the tax that's going into it. And on a pension, you have a couple of options. It could be from your pocket after the taxes have been paid, then you get that tax back. Or it can be from your gross salary, or if it's your company, straight in.
That's not to say that there aren't tax efficient investments for companies to make within the company or within the structure of the company, but that will require separate discussion compared with what we're talking about today. So if that's relevant, feel free to get in touch and we can touch upon those tax efficient company investments. And Sonia, you said, would it be advisable to put £10,000 in an ISA and £10,000 in a stocks and shares ISA? Well, Neil, what do you think on that?
What, cash ISA? It's not about advisable to person A to person B. I mean, it's really the situation. In layman's terms, if you need some easy access money and you've got no other funds you want to tie up long term, better off having it in an ISA potentially than sitting in another bank account where you're going to potentially pay 20 or 40%. So there's that argument. But in reality, your allowances should be utilised where you've got the potential to make the most money. But for some people, they may not be in the situation where they can afford to tie up all funds. So by splitting it, you can do that. And in all reality, you can have a stocks and shares ISA and have a cash fund within there. So you can utilise a stocks and shares ISA with just a heavier cash holding within it. So there's many options.
Yeah, it kind of comes back to what I said at the start in terms of the confusion around what an ISA actually is at its basic form. And, in terms of a stocks and shares ISA, well, you could open a stocks and shares ISA and still only invest in cash. So any investment decisions should be based, really on your individual circumstances, what this money is being put away for, when you're going to need to access it, what is your risk level, and how long do we have for that money to grow. If it's 6 months, then probably a cash is a good enough holding. But if it's 5, 6, 10, 15 years, then we need to look at something else in terms of maximizing the growth potential of the fund.
Yeah, I mean, for me, the ISAs, the pensions, in reality, you can hold similar investments in both. The wrapper is just the wrapping paper that makes it tax efficient. Obviously, with pensions, we have a few other options available in pensions, which we haven't really gone into detail today, and we'll probably do another seminar on that. But obviously, we have a lot of clients within Fusion that utilise their pensions to invest in commercial property. This can be done through numerous directors or as an individual, and obviously you probably need to build up a fairly sizable pot. Certainly do if you're in London, but if you're looking to buy a commercial property, industrial, maybe somewhere outside of London, then the amount you may need to purchase that property within the pension pot will be significantly less. We have a lot of clients that utilise their pension wrapper to facilitate that, whether that's an investment that they rent out through their pension to another company, or if they facilitate it for being their own landlord. So again, not something I want to go into loads of detail with today, but just really wanted to kind of go through the different options available.
Yeah. Yuri, I'm not going to read your question word for word because it's a bit personal, but I'll summarize the situation. So, essentially, if you missed the 23-24 contribution to your pension, and that meant that your tax bill in that year was higher, what does that mean for this tax year? Well, this tax year, you could make the contribution that you missed last tax year. And again, that would bring down your tax bill because any of the contribution you're making is going to be on a gross basis. So, you're going to get that tax relief on the way in this tax year. So nothing to worry about in terms of the tax already paid, but let's bring it down this tax year so that you're paying less tax.
Yeah, I think it goes back to what I said and you confirmed before. It's probably more of a concern if you didn't make a contribution and you were paying, well, any tax really in 21, 22, this is your last chance to try and get some of that back. So that's the year where it's more fundamental.
Yeah. And next question, it says, can you take money out of your ISA at any point? Well, yes, you can. So, what that would mean is, if you wanted to get the money out, you would either make a request to your financial advisor or the bank, and they would send you the money. Now, the caveat to this is, can you then pay it back in and regain the allowance? So that depends on what type of ISA it is. Now, there's some ISAs that are called flexible ISAs and some which aren't flexible. If they are flexible, any money you take out in that tax year can be put back in later in that year. If it's not flexible, tough luck. That one's gone forever.
Some people won't always know, though, where to find that. Usually when you have your own ISA set up, if you find where it says allowance for the year, if it's more than 20,000, the likelihood is that's because either charges have been taken out or you've taken some money out and you're able to utilise that on top of the normal 20. So I hope everyone's found that useful. Are there more?
No, we've still got some more questions.
Okay.
You're not getting away that quick, Neil. So, Irfan, you said, can you have a personal pension and a company director pension at the same time? Yes, you can. The question I'd ask is, why would you want to set it up in that way and not just have a flexible pension where you can pay into it through the company and personally as well? So that all comes down to, what is the purpose of your pension scheme? What is the reason behind it? And does it make sense to have one single scheme or multiple schemes that you've, built up over the years? And that's something that, is worth exploring. It's always worth getting the advice on that, because it may be that some of the other schemes that you've got have underlying benefits or additional benefits like enhanced tax-free cash or guarantees of annuity rates or something like that. So always worth checking in terms of, what is the best circumstance for you. But we're happy to help on that as needed. But just run through them now. So it says, hello, how does the split year tax system work when moving abroad, especially in regards to selling assets when abroad? So, Neil? Bearing in mind, we're not tax advisors. We work closely with Fusion Tax, who, give us good information. But anything specific like that, probably a conversation or a discussion with them would be more suitable in terms of that split year.
Yeah, it's always going to be unique to the time spent outside and each person's situation, and assets also being held and so on.
And then I think it's the final question from Nick. So it says, is there any benefit to paying the tax-free lump sum back into the pension? Now, it's an interesting question. Neil, your thoughts?
So if you're able to do it, obviously you're getting that money out tax-free, and then depending on your tax situation, you pay it back in, and then you are effectively getting a bump up on that.
Mm-hmm.
Now, can you take that money out tax-free again?
Only 25% of it.
So, yes, it may have a significant, an insignificant impact, but I think the biggest focus is really to just build up a sizable pot that you've got a good tax-free element to it. Now, tax-free element, you talk about lump sum, which a lot of people do utilize to, I don't know, pay off a mortgage at the income. They may have a little bit of a mortgage left over. But if there isn't a need for a lump sum, why don't you take that lump sum every month?
Mm-hmm.
So, for example, you have a pension pot, you've built it up, you're ready to retire, you're taking 3,000, 2,000 a month from your pension pot. If you don't need that lump sum, you could actually have 25% of that income tax-free. So for everyone's situation, it's going to be different. And you do have the flexibility of probably taking some as a one-off lump sum and then having a split for using other parts of that tax-free cash for a part of your income being tax-free, which will just help in your retirement paying less tax, which is what we all want.
Yeah, it all comes down to your individual circumstances and what you're looking to achieve. And, there's been a lot of questions. There's just a couple more to go. So is there any special advantage to contribute to a SIP, which is a type of pension, instead of a LISA, which is a lifetime ISA? Now, it's a good question because the benefits of a lifetime ISA allow for potential property purchase. And so if the goal is to use that tax relief or tax top up or tax bonus that the government give you in the lifetime ISA, then the lifetime ISA is going to be the best structure for you because you're going to be able to access it much earlier than you can with the SIP. However, if the lifetime ISA is being used so that you can access it when you get to retirement at age 60, well, this is all going to depend on your tax situation. If you're a basic rate taxpayer, then maybe the lifetime ISA is the better option. If you're a higher rate taxpayer, well, your tax relief is going to be 40% rather than just the 25% bonus that you get through the lifetime ISA, in which case there's probably more benefit to open it up with the SIP.
Yeah, I mean, first of all, I think lifetime ISAs, although I believe they're a good thing, haven't really been as much of a success as they should have been. They're not as readily available, but we have a number of clients that use them. On my side, predominantly it's for children as they start their first jobs, that the parents want them to start really, while they're living at home, building up their deposit and utilising some of their ISA allowance for that. And for that, it's amazing. I mean, they're getting some free money from the government. They're building it up. And again, I keep on saying it, and it doesn't matter whether you're young or old. It's about behaviours. So these allowances are great. They can really have an impact on your finances, but we also need to think about the behaviours we set ourselves to really make the most of our hard-earned money.
Great. And then just finally, final question. It says, it was said that one can put up to £20,000 per year into an ISA, and then you can draw it out tax-free. How long do you have to wait before taking it out tax-free? Well, you can take it out the very next day. The idea of it being tax-free is essentially, you've already paid tax on this money that's come to you. So the investment going into the ISA is a post-tax investment. Now, the benefit comes, Neil.
Yeah, so for me, the money goes into the ISA. Now, if we're talking cash, time doesn't really affect things other than every year you get a bit more interest. If you're going into investments, your biggest benefit is time. So if you put money into any investment, you want to know you've at least got a good timescale ahead of you. Doesn't matter what investment, whether it's outside of an ISA, you buy a property, you want to know you've got enough time to really make that growth work. If you invest in an ISA and suddenly regret it 6 months later, who can tell you whether in 6 months' time markets are going to be north or south? Whereas over 3, 5, 10-year basis, certainly 5 to 10 years, there's a strong likelihood that it will be north. Therefore, time is your best friend.
Brilliant. So I think that's it for the question. I'll double check. There might be one more that's just come in. And it says, is the first meeting a free consultation? That's a good question, because it leads me on to the next point. Yes, the first meeting, is always just a discussion. It's a free consultation, just an idea to get to know you, understand your circumstances. What are you looking to achieve? And the most important point, can we add value? And if we can add value, then it's worth having a conversation beyond that. And we can talk about the fees and that kind of thing post that.
Yeah, and it just gives you that opportunity to use us as a soundboard, and hopefully we can work with you. So there's no harm. On that note, I'd like to thank everyone for their time today.
Yeah, thanks for the questions. It's very interactive today, which is makes a change.
Lovely. Everyone, have a good end to the week, and hopefully we will hear from some of you soon. Thank you, and have a good day.